Hello, everyone, and thank you so much for joining us for our quarterly investment commentary webinar. I'm Margaret Sargent, Senior Marketing Associate here at New Frontier, and I am very pleased to be joined today by our President and CEO, Dr. Richard Michaud, our CIO, Robert Michaud, and Research Analyst, Joy Zhang. So today's webinar is going to begin with Robert for a review of our investment philosophy and process, followed by a look at last quarter's performance for both our portfolios and the overall market presented by Joy. And then Dr. Michaud will share a discussion of his quarterly market perspectives for Q4 2019. And we should have some time for Q&A at the end before wrapping up with a couple of updates from marketing. So just a quick housekeeping note before we begin. Your lines will be muted for the duration of the call to reduce background noise. So if you do have questions, please submit those using the chat feature of GoToWebinar, and we will get to as many as we have time for in the Q&A session. So without further ado, I will pass things over to Robert.
Thanks, Margaret. So at our core, we are an institutional research and investment advisory firm. We started based on an idea to improve modern portfolio theory through the integration of modern statistics, understand what happens, how to properly build a portfolio, given that we don't have perfect information. And so much of our publications, our research, our technology, and of course all of our investments are built on how to properly diversify a portfolio in an uncertain world, how to do sophisticated approach to portfolio construction and so to that end, we have quite a number of publications. We have patents for our technology, and we have, of course, just completed our 15th anniversary of our track record. So I'm sure Dick will be happy to tell you all about our research in his presentation. So just getting the web camera all straightened out, and I think we are good to go now. So our investment, the nice thing about our investment strategies is how we have a consistent investment process that really ties in across all investment objectives and across standard, tax-sensitive, and multi-asset income portfolios and across all risk levels. Here they are. So I can't emphasize enough that we build our investment strategies with our best ideas consistently across all portfolios, but for these 15 different objectives. And so whatever the past performance has been, the future outcomes are most likely to be best for if you're matching the investor's goals with the portfolios. And I'm mentioning this because we do occasionally see somebody who is maybe a total return investor, but likes the recent performance of one of the other strategies and maybe ends up in a not best fit going forward for the portfolio. So I think we do a good job of giving a broad array of investment strategies that are really matched up with investment goals. And the investment process that I'm about to describe really applies across all of them. So first thing is we want to take our institutional philosophy, tie it into a process, and where you start with that is try to understand what are the global markets saying about the in return across asset classes all over the world. And then you think about does an asset class have a risk premium? Does it have a low correlation? And then think this is a suitable asset class for investment. Match it to an ETF. Then we estimate the risk and return. We're trying to balance thinking about the return going forward with past data and use that with by using statistics to incorporate information about not just history, but also current economic conditions in terms of things like yield curve, shorter-term volatility information, credit spreads from the derivatives market, as well as applying academic theory on the return premium, small cap premium, things like that, to add some sort of consistency to this forecasting process. And then, of course, we apply optimization and rebalancing. And our investment committee is here in Boston. We're meeting every week. We're reviewing these things. And actually, one thing that's quite special about us is that the rebalance tests are run on an automated basis to monitor all 15 of the models that I showed you on a daily basis to make sure that they have the appropriate risk characteristics. Now, optimization, that's really much of our research and much of our technology, and one thing that really differentiates us. And for many investment strategies, a typical one, maybe you would have a portfolio group that tries to come up with a set of bonds, a different group that comes up with a set of stocks, and if they want to build risk-targeted portfolios, then they just connect the dots for these things. And from our perspective, this is, first of all, what happened to Markowitz's theory about using optimization to come up with clever combinations based on their asset correlations and relative risk and return characteristics, so that we can maximize risk, maximize return, minimize risk across the efficient frontier. And this is a interesting way that, without having any special information about the future, just through good portfolio construction, you actually can add value and improve risk-adjusted return for portfolios. Now, that's the theory. Another thing that's just very intuitive is, are you really building the most suitable portfolios that you can for investors? And in this case, I can illustrate with an example where if you're just adding more bonds to a conservative portfolio or just adding more stocks to an aggressive portfolio, then you're not really tailoring the portfolio to the investor's objectives. And here's a simple example which shows what the bonds look like in a conservative portfolio versus an aggressive portfolio. And the intuitive answer and our answer is that they should be and are quite different. And in a conservative portfolio, there's lots of short duration, not much credit risk. In an aggressive portfolio, the whole portfolio is constructed to aggressively go after the return premia available. And so you actually don't see any more short treasuries in a more aggressive portfolio. Now you see more high yield markets and longer duration and credit risk. Now, optimization is great, but you have to do it right. And one of the things that we mentioned is that there's a lot of uncertainty in information there. If you're just looking backward, you're not going to build an effective portfolio going forward. And there's much research that shows that optimization can be overly specific and maximize the errors in your forecasts. And so we wanted to solve this problem by taking a more realistic. And what we did is we looked across thousands of different scenarios. And instead of building a portfolio that's optimal for any one specific one, we build a portfolio that's going to perform the best on average, given that you don't know what the future holds. And so this is the new Michaud efficient frontier. One very nice endorsement for this is that Harry Markowitz did research on it. He published a paper. It took him a few years to work on this, and he came up with the result that actually, even in his test, he did 30 different tests and found that in every one, what we did is an improvement over the alternatives. And so then the final piece of the puzzle is rebalancing. So we're building a constructed diversified portfolio. And then we want to make sure that we're looking every day to make sure that they have the right risk characteristics. And so just generally what happens is you'll have an optimal portfolio, a nice portfolio on the efficient frontier. You'll trade an account to that portfolio. But then over time, prices change and the portfolio drifts off of the portfolio frontier. The other thing that happens is that new information arrives and your whole concept of optimality evolves over time. Not radically. We're not a tactical manager shorting things or going completely in and out of asset classes, but our portfolios do evolve as international markets evolve as well. So is the portfolio that most of the clients are invested in, is that similar to, or is it statistically significantly different from this again through modeling the possible scenarios that the world could be in right now, and we look at potential alternative optimal portfolios, and we see essentially, what's the likelihood that the portfolio you have now would be better off being traded to a new optimal portfolio or remaining as it is for a little while longer? And so we do that. We're a strategic manager, but we don't just trade on a calendar basis. We have traded between 1 and 3 times a year when it's actually of a benefit to the investors for us to trade. So with that, I'd just like to sort of summarize some of our main ideas that advisors like to keep with them. We have a dynamic forecasting process where we're trying to understand markets now, not just markets looking back, and so we call this strategic, not static. So everything we do is based on evidence and data, but we do adapt to the market as it changes. From the hip and taking big bets. So we want to be very conservative in every way that makes sense. So what I described is we're not just betting on one view of the markets. We're literally looking across thousands and building a portfolio diversified across all of those. But we're also not picking our favorite asset classes. We're not trying to time markets. We're investing in ETFs rather than actively managed funds, which it all leads to a greater amount of consistency, a greater amount of transparency, and reducing unnecessary risks in the portfolio. And then finally, we're really focused on asset allocations. So, and you've certainly heard that asset allocation is one of, if not the most important investment decision that people make. So it really helps to have some skill in that area. So from here, I'll move over to Joy, who will give you an update on what the performance looks like of these strategies.
Thank you, Robert, for the great overview of investment process. Now let's move on to the performance. So first of all, we have New Frontier Index performance in front of us. The indices here are Michaud optimized global indices that are constructed and rebalanced by the same investment process Robert just went over. The indices represent 6 stock-bond ratio ranging from 2080 to all equity. Dick will talk more about index, but let me highlight their excellent performance first. So looking at the performance, we have light blue and dark blue representing our index Q4 and 2019 performance. In yellow and black, we have blended equity and T-bill benchmark performance for the last quarter and the last year. 2019 has been a really great year for the investors. All New Frontier indices reached new highs in 2019. Looking at the graph, we can see that our indices are outperforming their benchmarks, up to 5% on a year-to-date basis, with all equity index and the GEI being largely in line with this benchmark equity. We saw slightly reverse performance in the last quarter. For that, I will talk more when we get to the asset class performance. Here, the same happy story goes for our tech-sensitive portfolios. Again, a really great year for the investors who invest with us. Again, a slightly reverse. Now let's move on to our multi-asset income portfolios. I can never talk enough about their great performance, with 2019 being no exception. They not only provide high absolute returns, but also provide consistent and stable yield, which is roughly at 4% range right now. So that was our great performance for our portfolios. Now let's move on to the asset class performance and see how things got changed. First, we have equity performance. In light blue, we have Q4 performance. In dark blue, we have 2019 performance. As we already knew that 2019 has been a really great year for equity performance. Actually, it's one of the best years for equity market since 2006. On a year-to-date basis, U.S. market has been leading global equity market, with U.S. rates and U.S. large cap being the top performers. Interestingly, we saw things kind of reversed in the last quarter, with emerging markets, especially China, international small cap, and Europe being the top performers in the last quarter, while U.S. rates, U.S. large cap, and U.S. small cap slightly fell behind in the last quarter. And on the fixed income side, good year for bonds in general. Again, also U.S. aggregate bonds has the highest annual return since 2003. Interestingly, we can still see the reverse pattern here in the last quarter compared with the last year. And this combined, what we have talked in the equity section, they together explain the reversed performance for our portfolios in the last quarter. So things have done really well in the first 3 quarters, didn't do well in the last quarter, with duration being the example. Long treasuries, intermediate treasuries has gained a lot in the first 3 quarters, but they fell behind in the last quarter. Credit, on the other hand, has done consistently well over the last year, with long corporates and investment corporates being the top performers on the year-to-date basis. So we have seen the really good performance for the stocks and bonds. So some people may wonder, since they were moving up in the same direction in 2019, are they positively correlated? If that's the case, how do we use bonds to manage our risk? Particularly, we often get questions about our positions for long treasuries in the portfolios. I believe the key to that question is to understand long treasuries in the context of our entire portfolio instead of its own. This chart clearly shows the correlation between S&P 500 and long treasuries in 2019. For example, in May, when people were very concerned about escalation of trade tension, S&P went rapidly while long treasuries went up in the opposite direction. So the diversification effect brought by long treasuries to our portfolios is consistent and persistent. As far as our asset allocation changes, we rebalance our standard portfolios with interest rates and yields. Major allocation changes include decrease in duration exposures, partially offset by an increase to mortgage-backed securities, and also a moderate shift from developed international equities to domestic. One outstanding change I want to highlight here is the transition to new high-yield ETF, USHY. Compared with the previous GNK and HYG in our portfolio, USHY has much broader exposure to high-yield market, with smaller issuance and more high-yield types being included. With this high-yield target risk characteristics, when other fixed income securities, and thus adds efficiency to our optimization process. Lower expense ratio is never our top reasons to include a ETF. However, it doesn't hurt to have a lower net expense ratio of 15 basis points for USHY in our portfolios. And we have been closely monitoring ETF since inception, and we have been waiting for it to become mature and have enough liquidity to be included in our portfolios. So that was all about our performance and asset allocation changes. With that, I will pass it to Dick to talk about market perspective.
Hello. Thank you. Thank you, Joy. Thank you for the performance perspective here. And now I will continue with the New Frontiers market perspective discussion here. The title of the commentary was New Highs, very good. Anyway, so let's begin. 2019 was a great year for investors, right? The annual S&P 500 return was 31%, Dow 25%, and Nasdaq an amazing almost 40%. A good $6 trillion of equity wealth created for domestic investors, and international participated very nicely with 26% return. But many did not participate. Half Americans do not own stocks, but many others were spooked by new highs during the year. Can't go higher syndrome. You know, the forward brow experts who promoted defensive low return strategies during the year. We all remember many of them. But there was a volatile third quarter, an inverted yield curve, global recession fears, the Fed uncertainty, and of course, the perennial Washington dysfunction, apparently. So anyway, there were reasons for people to be concerned. However, 2019 does have some lessons for all of us. Investing is often confused with trading, and that is what often happens in the business channels and in the media. But short-term trading requires accurate forecasts for success. It's not the reliable way for long-term investors. Good long-term investing and probably a quantitatively oriented resolve. Longer-term political, economic, and capital market events are the key for thinking about long-term investing. And so you should always be focused on economic and geopolitical secular trends, if such things exist. The stock market democratization, for example, is very much a very important secular trend here in the United States. There are trading fees and fractional shares, but we also have a robust U.S. economy, a thoughtful Fed, the strong consumer sentiment, and China trade agreements are a very important part of what's going on in the markets right now. So it is often difficult to appropriately compare a market's performance to public benchmarks and other managers. There are many different kinds of regulations and fees. There are many ways of categorizing managers and categorizing strategies. All you need to know is how many different ways Morningstar does that, for example. There are many ways to obscure fees, and manager visibility may often be purposely limited by some institutions. So how to help advisors and clients to find useful, available benchmarks for comparative asset management performance? This has been an unsolved problem in asset management. So what we have done is to have at the S&P Dow Jones compute New Frontiers indices. It's based on 15 plus years of core portfolio performance in index form. It's not a back test. It's the index is defined to mirror our management decisions. The returns are, of course, gross of manager fees, which is not very large, and trading costs, which are almost non-existent. But the index is net of ETF expenses, and of course, it's available on Bloomberg, Yahoo, Morningstar, New Frontier website, smartphones, and very interestingly, on the Apple Watch in real time. So the indices offer a convenient comparative performance framework available to anyone on this call relative to other public indices and to any other managers on Bloomberg, for example. The Apple Watch performance is available on real time on my watch. No other manager, as I know of in the world today, has such indices available to investors and institutions. Okay. So one of them is the New Frontier Global Equity Index, NFGEI, and it is almost identical to the MSCI Equity IMI Index. And we did it with 14 ETFs, as I remember. So we can compare global domestic markets in real time. It's an amazing thing. But I compare our equity with the S&P often during the day to understand exactly what is going on in capital markets. So the New Frontier Global Balanced Index, the 60/40 Index, NFGBI, is a different kind of index. It provides a very convenient institutional and advisor benchmark. It is, I think, the only one of its kind. This year, almost 21%. By the way, the 60/40 balance of the MSCI and FTSE 3-month T-bill, 16.7%. That's more than a 4% return. So that can cover an awful lot of fees. So intelligent active management can beat passive indices after fees. And by the way, we have 4 other core indices, all of which provide a new performance standard for institutions and advisors. I think this is one of the more important innovations of New Frontier that New Frontier has produced in the investment community. So now let me look ahead. Major issues for investors in 2020: political risk, trade wars, Fed, China, deficit, ECB, and I'm going to have some thoughts on global diversification. So Domestic politics. Political risk is the single most important risk factor for capital markets. Eugene Farmer. I couldn't agree more. Political risk is the single most important risk factor. So we need to think about it, okay? 2020 is a presidential election and an impeachment year. Only the third time in U.S. history a sitting president is being impeached. Normally presidents try to retire or resign before they get impeached, and this will be the third time. It is widely assumed that the Republican Senate will acquit President Trump. How the trial is on the 2020 election. Who wins the 2020 election is also very important for the country in terms of its future direction. We have issues like deficit spending, environmental regulation, immigration, social programs, economic policy, foreign policy, and the judiciary. The Wall Street and NBC News poll that showed up in the Wall Street Journal in late December, the president from office, 36 supporting him. I was really pretty surprised by these results, but they are what they are. While economic satisfaction is the highest reading in the past 3 decades, according to the Wall Street Journal, the market is not going to be that helpful one way or the other. Recent job approval for the president stands at 44%, and amazingly, 48% are certain to vote against Mr. Trump, regardless of who the Democrats nominate. Pretty sobering stuff. The internet factor is also something important to understand in terms of the electorate today, okay? It's been an era of Facebook, Twitter, Instagram, and other social interactions that have, right before our eyes, fundamentally changed the framework for social interactions, political discourse, and information in America. No president has used social media to so dominate domestic politics as President Trump. And we have to add evidence of foreign interference using social networks to foster dissension among the American people. So, conference on this webinar, anger and fear in the electorate should not be unneeded. Impeachment will stoke the country's deep political polarization, and likely anything, including very unusual, first of its kind events are likely to happen during this election year. It should be a strange time for the country. Well, let's go to markets. The Federal Reserve wants to be perceived as nonpartisan in an election year, and there were 3 rate cuts in 2019. It's what they should have done. There's a healthy economy, there's a robust consumer activity, and GDP growth is right in line with forecasts, and inflation is not a serious concern. So there's little reason to cut or raise rates for the moment, and a no cut, no increase Fed policy is likely to go through pretty much all of 2020. The good news, Congress and President passed funding for the government through September 20th. So that was a nonpartisan achievement. But funding agreement ends before the election, so we have to keep in mind that. The bad news, of course, is that fiscal deficits are climbing at a very fast pace. Spending is outpacing federal tax receipts. The budget deficits are projected to average a cool $1 trillion or more per year for the next decade. That is another sobering thing for people to think about. In previous expansions, the U.S. attempted to climb out of a recession, but despite low interest rates and an expanding economy, no serious policy exists for reducing the deficit at this time. It is an enormous lost opportunity for the country, I'm afraid. Now, the repo. Growing deficits can coincide with the repo issues. Okay, there was a short-lived spike in the third quarter, and what was concerning about it is that the spike occurred not at quarter's end, but 2 weeks before. So the Fed is well aware of the issue, and they are feeding dollars into the economy, but unfortunately, the need to manage the repo required restarting bond buying program, which scraps any hopes of normalizing monetary policy. This is a reason why ultra-low rates may remain for quite some time. It's hard to see where things are going to change very soon. Is the cure worse than the disease on a longer-term basis? It's something to think hard about. The president's trade initiatives are arguably the most significant of his presidency. He struck a deal with Canada and Mexico, rewriting the North American Trade Agreement, and the Senate and President the Senate just approved it today. So the U.S.-Mexican-Canada agreement is important because it is a template for the administration's effort for new bilateral agreements with China, the EU, the UK, the Japan, and anybody else. So the world's focus has been mostly on trade relations with China. China and Trump are engaged in a bitter tariff game of chicken. Do you know what chicken game? Okay, in-game theory. Think about it as two hot rodders, something like two persons with in their cars heading straight for at each other as fast as they possibly can. And who loses is the guy who chickens out and doesn't slam into the other car. Unless then both lose big time. And the Trump relations with Trump and China has been in this kind of world. So recently, both sides relented and are signing a Phase 1 agreement, and they have signed it today. The new agreement, it does roll back some tariff increases and suspends some new ones. It does have some buying by China, but it does not challenge basic China economic policies. So China's promise to respect intellectual property rights and no forced tech transfers seems highly dubious for many, many people. The world's second largest economy has been hurt by a trade war. It needs to grow rapidly for fiscal and political stability to advance the country's strategic and military ambitions under presidency. So China manages the economy with cheap credit, privileged domestic market access, state subsidies, stolen intellectual property, and shields Chinese firms from foreign competition. But the U.S. has a consumer market necessary for Chinese exports, a far more adaptive and diverse economy, which is the reason why President Trump can threaten to walk away from any agreement he doesn't like. However, like the game of chicken, right? Neither side can claim a victory. The trade war has added new costs for business chains and put off investments and hiring in many cases. By the way, there's been a sharp rise in the value of China's A-shares. Now, the Shanghai A-share index has risen almost 24% this year. In contrast, the performance of the offshore index, Hang Seng index, is only up less than 14%. So what's been happening? The composition, excuse me, of the MSCI, Emerging Markets Index, which is very popular with American investors, has increased the allocation to China A-shares from 0 in a 3-step process, which is now finished with its current rate of 4.1%. There has been a lot of new money going into Chinese A-shares recently. The 3-decade bull run in fixed income continued in 2019. A number of indices were up quite a while. The Barclays U.S. Treasuries, for example, was up almost 7%. ACK was almost up 9% at year end. But the sentiment was much less upbeat at the end of the year. So Treasuries were negative for the quarter, and ACK was negative, no, not negative, but very barely positive for the fourth quarter. And the Dow Jones REIT index had the same kind of character, up well for the year, but down. However, the love affair for junk bonds in search of yield, and everybody's looking for yield, so the Barclays yield index still is up this quarter, and of course, very well up for the year. The European Central Bank, the bank presidency has passed from Dr. Draghi to Madame Lagarde. She announced no change in Draghi policies for now, but is also having a comprehensive review of policies for the future. Trade stimulus policies. Many economists have criticized the policies as ineffective. It's a very controversial. Stealing German savers' money and creating asset bubbles and conflicting with elected government policies. That's a big deal. And the problem for a lot of people is not cheap loans, but where to put the money to work. So Draghi leaves the ECB with a slow growth economy, trade disputes, low inflation, limited room for changes. Malgad says, thank you very much, Dr. Draghi. Sweden recently scrapped its negative rate policy for stabilizing the krona. And this is, I think, an important issue, really, really important issue for trying to understand global markets. Sweden was one of the earliest proponent of negative rate monetary policy, and at first to charge banks to hold deposits rather than pay interest. And then in 2015, lowered the key rate below zero to stimulate the economy. But while successful in its original objective, household debt is higher, krona is weaker, the banking sector stability has been threatened, pension funds are forced to hold negative yielding securities, and better than free money is encouraging asset bubbles. So the rate hike now, just recently, as a tacit admission that side effects in investor behavior may outweigh benefits of a negative rate for too long a time period. I think this is something that all of the theorists of monetary theory and monetary economics need to pay a lot of attention to. And just quickly, Brexit, the election resolved the political uncertainty for the UK, positive for both sides and so on. There's a lot of skepticism about whether it was really the right thing for the that's they're going to be their problem. For the European Union, there's really hardly there is likely to be a fairly significant impact on the British economy. So let me finish here with a couple of thoughts on the global diversification. Okay, well, while 2019 was something of an exception, international investing has been uncompetitive relative to a pure U.S. strategy for some recent years. So what are the prospects for the future? Okay, Union lags in many cutting-edge fields where the U.S., South Korea, and China dominate. They file fewer patents. They invest less in future. The Eurozone has been held back and will continue to be held back by its financial, political, governance structure. And monetary policy is no substitute for a coordinated Eurozone fiscal stimulus policy, which has little to none chance of happening anytime soon. But China must also deal with political restiveness, which is a very serious issue, a slowing economy, and a far from resolved trade agreement with the U.S. On the other hand, and the economists love other hands, right? The U.S. could see technology competitiveness diminish. Research and infrastructure largely has been ignored in the political dysfunction in Washington. The hopelessly partisan process favors too often ideological over practical. Very limited progress for quite a long time in skills gap, education, immigration, medical care, and business investment uncertainty. So just to think of one simple example, as I was writing the commentary on January 3rd, General Soleimani was assassinated by orders of President Trump, and he's part of Iran's Islamic Revolutionary Guard. So for totally unforecastable risk, which I want to remind all of those of you here, it's a reminder of the essential importance of good, effective global diversification. It truly is the only reliable hedge for good long-term investing and risk management. So one final happy thought is that it is unusual to get 3 publications accepted for publication, 3 papers accepted for publication, pretty much all at the same time, and happily enough, that is what has happened at New Frontier. So we have a paper that is coming out, and in the Journal of Investing, it has been in the works for some time now. We also have a very serious and important comment on a very serious and important paper in the Financial Analyst Journal, which was something of a critique of some of the work we have done, and also a critique of us as well in the Journal of Portfolio Management that the editor seen fit to publish as well. So we are very much in the news as far as SSRN ResearchGate and our website is concerned. So thank you. And now I'm going to turn it back to Margaret.
Great. Thanks, Dick. So just another quick reminder, your lines are muted using the chat feature of GoToWebinar. And it sounded like maybe we wanted to have a little bit of a discussion here as well as we're waiting for questions to come in. I think you, Dick, maybe had another thought to share about the indices.
Well, I just wanted to mention that the differences between our index, even though the index doesn't have all of our the costs of investing, nevertheless, it's relatively minimal additional costs, and the performance has been pretty good. Joy?
Yes, we have already seen the performance section that our index has been consistently and dramatically outperforming the benchmarks, the blended equity and T-bill. In 2019, up to 5%. So it has been really good.
And Robert, the academics tell you that intelligently managed portfolios can be common indices with passive indices. Is that right?
There's a lot of there's beliefs in the supremacy of the market portfolio. There's beliefs that passive investing is the only way to go. There's a lot of questions, though, about what this means for the future, in that if passive investing is so much better than active investing, then why would there be any active investors? And if there's not any active investors, then how can prices exist? So there always has to be some sort of equilibrium between informed investors who can make informed investment decisions and profit from that. But for the huge majority of investors, they're better off just being free riders. And this is free riders in the nice sense of the word, where you get to let somebody else do the work of trying to price the assets, the small fraction of people with information and portfolio construction. And but not the market portfolio. The other thing is the market portfolio is not the portfolio for everyone. And I think this is where we come in.
Yes.
If you remember from the optimization graph, there's the straight line, and that's the market portfolio. Everybody's in the market, or half the market, or 1.5 times the market. But an aggressive investor might not want a conservative investor. And that gives an opportunity for intelligent portfolio construction to actually outperform the market.
And much of our research has been pointing out that quite a bit of the technology that people have been using for making investment decisions may have some limitations. And we have, the two of us with David Esch, have been trying to improve that technology, as Harry Markowitz is willing to admit and accept. How much do you think that the improved technology really is the key to our better performance?
Well, simply put, without the improved technology, you can't accurately build a portfolio that takes into account all the investor objectives and also takes into account the very high dimensional problem, many different global asset classes, but all of which are not known perfectly. And so it's critical.
Great. So it looks like we don't have any questions coming in right now, so I'm going to go ahead and share a few updates from the marketing team. So just wanted to highlight a few of our upcoming events. So Dick will be presenting both in January and in April. In January for the Southwest Financial Planners Conference, and in April for the Both of those are going to be really interesting talks. So if you happen to be in the area and you are interested in attending those, the fundamental law presentation in reference to the paper that is forthcoming in the Journal of Investing, and the Beyond Modern Portfolio Theory in January should be a really fascinating presentation. In March, we have our second annual asset allocation workshop here in Boston. That's going to be Robert presenting, and that's going to offer a chance to really explore kind of cutting-edge portfolio management techniques and engage with our multi-patented investment technology. It was very well received last year, so if you are interested in deepening your understanding of asset allocation and really exploring, what's cutting edge in terms of investment technology today, I really encourage you to join us for that. That'll be again here in Boston on March 12th. And finally, in June, we are going to have the third iteration of Dick's Finance's Wrong Turns research. This is really fascinating stuff. It's been fantastically well received in the last two iterations. It was initially a 5-part lecture series presented in partnership with the CFA Society Boston, and then we revisited it again last summer for a one-day conference. And we will be using that one-day conference structure again this summer. So stay tuned for more information on that because that's going to be a really interesting piece that we're very excited to bring back by popular demand. As always, you can find information on all of our upcoming events on the events page of our website under the News and Insights tab. This is the team that is here to support you, our advisory and wealth management consulting team. David Schubach and Nick Lamb cover our Eastern Division, and we were very fortunate to add Keller Schluter to our Western Division, working with Jesse Andrews. So these people are here to answer any questions that you might have about our portfolios, and if you were unsure, feel free to reach out to our main office and we can connect you with a consultant. Dick talked extensively about our New Frontier indices, and as he said, these are available anywhere that you would normally access on Bloomberg, on S&P, on Yahoo Finance, and of course that also means that all of the performance is available in real time, either on the browser or on your smartphone or smartwatches, other devices, so you can track the performance of these in real time. As always, I encourage you to take advantage of our Frontier Advisor portal, which is designed to be a one-stop resource center for advisors. You can download materials, review portfolio analytics, and also engage with our proposal engine to run custom proposals for your clients using New Frontier portfolios. And those will generate a custom proposal with both detailed portfolio descriptions and analytics, as well as comprehensive educational material that you can share with your client. And that is everything that I have for you. So thank you again all so much for joining us for this Market Perspectives webinar, and we will see you on the next webinar. Have a great rest of your day.